Ladies and gentlemen, hopefully, not only do the people here in the broadcast room in Philadelphia hear and understand, also though we have a webinar audience who we hope are hooking in, and we have other audiences in, I think, 5 of our 13 other offices, including Los Angeles, where part of this presentation will originate. My name, as explained on the card in front, for those who can see live, is Rick Ballard. My co-presenters are 2 of my partners here at Ballard Spahr, Linda Skokel and Kim Betterton. We are all 3 tax lawyers. We are all 3 totally heavily specialized in public finance, which is the backbone of what we're going to talk about today. Also, before they conclude that everything is safe and sound, and before they sneak out of the room, I want to thank Rebecca Anderson in the back in the white blouse and the black suit. Uniform. Did I didn't say that. And Peter Wright in the blue shirt. Rebecca is our communications and marketing manager for this topic today, and Peter is the head techie who put all these wonderful pieces of equipment together, hopefully so that this will come through seamlessly, or at least without attention to the hardware and mechanics involved. They, as I say, are from our marketing department and our information technology department. We 3 here at the podium are from what is loosely and colloquially known as the legal department. That's the way law firms are now. If you are in Wilmington, Los Angeles, Baltimore, Salt Lake City, or Phoenix, and mechanical difficulties arise, tell your host. If you are on the webinar presentation and mechanical difficulties arise, call the telephone number, which hopefully is still on your screen, but won't be there much longer because we're going to rotate the slides. If you are here and something goes wrong, use a traditional form of communication, something like manual digital movement. Wave your hand. The other person who is part of this presentation is Shelley Buchanan, also our marketing department. You see her. She is like the wizard in The Wizard of Oz. She is behind the screen, managing the webinar presentation. And all the people who have helped us with this, we thank hugely. On to our subject of the day. Schedule K of Form 990 has been with us for a couple of years now. There are some people in the room, although it will not be necessary to understand today that you'll be one of them. There are some people in the room who attended a presentation that we gave in this same room in December of 2008 to sort of introduce Schedule K. Well, there's been a lot of water under the bridge or over the dam or something, and I don't know what the repairs are, such as life. A lot of water under the dam, and it's become important, all the more so because Internal Revenue Service officials are cheerful to say that they are going to look at Schedule K, and if they see things on it that don't make sense, they will contact the filer in any of a number of ways, running from what they call soft contact, which is a phone call, to hard contact, which is a rather abrupt and brisk letter that you don't want to receive from them. So it's important. It's reviewed by the service real time, and that's why we thought that there would be interest in it, and we people here in recognition of that interest. With that, I'm going to turn sort of the magic controls, including the one that advances the slides, over to my partner Linda Scotto, who's going to start in on part one of Schedule K. Our presentation will go through the 4 parts of Schedule K, and we will be finished at 3:30, when frankly the equipment's all going to turn off and detonate. So if you're planning on leaving, be ready to leave. Oh, questions and answers. There will be a break about halfway through. We'll take questions. We think we can do it in a way that will allow everybody 1 or 2 shots. But if you can hold them until we're halfway through, that'd be great.
As a former classroom teacher, I know sometimes it's hard to hold the questions. So maybe you just write a little note so that you don't forget your question. And just because you forgot it does not mean it was not important. I'm going to run you through kind of the first 2 parts of Schedule K, and this may be the driest part. I thought I'd also let you know that we do have Schedule K in the instructions behind tab 2, and behind tab 3 is kind of a mock 8038, just to give you a sense and have some reference materials for you if there are questions that you want to ask related to that. So part 1 is very dry. Despite that, we have still found some questions have arisen, so I thought I'd kind of walk you through it. I know many of you have accountants that tackle the Schedule K first, and then at some point they may have kind of thrown up their hands and said, I think you need to ask somebody else to help us finish doing this particular form. And I found that's true even for part 1 of the bond issue. So let's kind of talk about what's the entry into Schedule K. And the first cutoff really is that the IRS, in what they considered a great concession, decided that you only needed to fill out Schedule K for bonds that were issued after December 31, 2002. So if you have older bond issues that are outstanding and they not touched them with a refunding, then you're not going to be filling out Schedule K for those particular bond issues. If you had a bond issue, say in 93, and you refunded it in 2006, you are going to have to file Schedule K for that 2006 refunding issue, because that refunding bond was issued after December 31st, 2002. Now you get a slight break. You will not have to fill out Part 3, which is the private use section, and the one that perhaps is the most troublesome in trying to figure out how to answer the questions. They're not as straightforward. But for those bond issues that were originally issued before the December 31, 2002, if you fund them, you're not going to have to fill out Part 3, but you're going to have to use that, in my example, the 2006 838 to get you started filling out the rest of the information in Schedule K. One thing that we've noticed is that what the IRS considers a bond issue may include a lease purchase agreement. So it could be that someone in the organization entered into a lease purchase arrangement with a vendor, and someone may have signed an 8038 because the vendor was treating that lease purchase agreement as a debt. There was an interest rate attached to it, and the vendor may actually have put together a package. There are some of them that are very familiar with hospital equipment, for example, and might put together a whole package. And there are some issuers we've worked with that have been surprised that there were additional bond issues out there because someone internally signed the 8038 without necessarily checking with someone else who might be filing the Schedule K. So lease purchase agreements, If they are issued on a tax-exempt basis, the vendor, you would be filling that out. Direct bank placements, that's kind of the latest thing, better than sliced bread. We have many of the banks that might in the past have provided you with a letter of credit that are coming to you and saying, I would like to hold those bonds on our own portfolio. So, you don't have to worry about whether we're going to raise our letter of credit fees in a couple of years. We're now going to do a direct placement. Even though it is a direct placement, if that agreement is signed by you as the 501c3, by a state or local government issuer, and the bank and documented as a tax-exempt loan, that would appear on your Schedule K. That is considered still a bond issue, even though it might have said a loan purchase agreement on the agreement. There is also the concept of if you borrowed money from a tax-exempt loan pool. Many of those done, but some of you, I imagine, still have some loans outstanding, maybe even from some pre-1986 pools. I think hospitals, there were several pool issues out there. So even though you might not have, as a borrower, filed an 8038, if you know that your pool loan came from a bond issue, you might still be responsible for recording that on your Schedule K, even though you might not have actually filed the 8038 filing with the IRS yourself. So those are kind of a preview of the bond issues that the IRS expects that you will be putting on your Schedule K form. So once you've identified which of those bond issues are going to go on there, one other thing I should mention is that it's not unusual for you to maybe do a Series A and a Series B. And if you look at your tax certificate, you may see, or your 8038, you may see that one 8038 was filed. And maybe the tax certificate would say, for tax purposes, we're treating this as a single issue. So in that case, you would be identifying that bond issue as a single bond issue. In other cases, you may have had one new money component and maybe an advance refunding component, and we may have suggested that you separate the two. And again, if you look in your bond documentation, if there are two 838s filed, then you would be listing the Series A separate from the Series B, for example. Okay, so now we have identified our bond issues. Questions across the top really on this one, they really are asking you to only look at the 8038 to answer almost all of the first few questions. So the EIN, that is on one of the 8038 form, and if you need to look at it, it's behind tab 3. We need up a name for the issuer. Then it asks you for the QSIP number. And bond issues will have several different QSIP numbers. The instructions to the 8038 are all you need to put is the QSIP for the latest maturity. So that's all that's going to appear on your Schedule K, too. So we had a Series A and a Series B. You're going to look at the 8038, and on line 9, there should be a QSIP number, and that's what you're going to transfer to the form Schedule K. Date issued, that's line 7 on the 38. You're just going to take that. A lot of bond documents may be phrased as dated of October 1st, 2007, but you probably didn't do the issue until, say, October 17th, 2007. So the actual issue date is what they're looking for, not necessarily the date of the document. So again, you're going to need to just take what's on the 8038 and write it in there. The issue price is not asking you what the amount of the bond issue is. It's asking you what is the issue price. And the issue price would be different from the par amount if you'd have some original issue discount or premium, net discount, something like that. So again, if you look on your 8030, well, there are a couple of places on the 8038 you can find the issue price, but perhaps the easiest place to find it is on line 21. So that information you're taking directly from the 8038. Now, part F, and they didn't give you much space to put most of this, but definitely the space in F is inadequate, because what they want you to do is describe the purpose of your bond issue. In some cases, you may be lucky and the bond issue did one thing. It financed one project. If you find several different projects, instructions tell you you can aggregate it. So if I both constructed and equipped a building, I only need to say constructed and equipped. I need to list them as separate, different items. If part of your issue was a refunding, the instructions say, tell us enter the date of the refunded bond, the date the refunded bonds issued. So that needs to go into that cramped little space under F. All of this means you're probably going to have to file an attachment with this. You know that you're finding that with most of the spaces in 990. They didn't give you enough space. So a general description of the purpose. It has to be a little bit trickier because the notion of the bonds being defeased has a special meaning for the tax rules. For your purposes, if something has been defeased, it's kind of off your books. IRS's standpoint, those bonds are still outstanding. Someone still holds those, and someone is still taking tax-exempt interest until you actually redeem them. So in G, if you had done a partial defeasance of a bond issue, you would check yes, set up an escrow to pay over time. If you had during the year, say if you're filling out for 2010, sometime during 2010 you set up a defeasance escrow, you would check that box there. Most of you will have done a defeasance in context of a refunding, but there are times where you may have just done a cash defeasance, or may have had a change in use of your facility, and so you had to defease a portion of the bonds as your remedial action, and Rick will talk a little bit more about remedial actions later. So in some cases, you would check that, yes, a portion of this or all of it has been defeased because you were doing a remedial action for a change in use. Maybe you sold the facility. On H, it asks whether you're an on behalf of the issuer. That is probably something the vast majority of you in here would not check. It means that a state or local government approved your articles and authorized you to issue the bonds without the state or local government actually being the issuer. I know we have some people here who are actually issuers, and depending on the status of the issuer, they may be filling out a Schedule K themselves. And again, I think Kim is going to talk a little bit more about that when we get to her section. But I think the vast majority of you can pretty well plan on checking no for that. And the final category is, are you part of a pooled financing? Financings have had a checkered history over time, and so the IRS still likes to check bonds. And even though you might have had to check on whatever 8038 you filed, you might have had to check that you were part of a pooled bond issue. They seem to want that information here too. So if you borrowed from a pool, in some cases, hospitals that had several 501c3s associated with them actually have issued pooled bonds and made loans. Maybe a parent makes a loan to of the 501c3s, and that is under our documentation. It would say that it was a pooled loan issuance, so you would check that box. So I'm done with part one. That's the easy section, and I'm going to move on to part two. All the questions in part two, and I'm probably going to take you through about question 16, and then you can listen to Kim instead of to me. but I'm going one at a time. And I will apologize, we kind of slipped up on this. Part 2, line 1, and the instructions are wrong ones, so I'll just kind of talk to you about them. We kind of repeated the instructions for line 1 when they really belong to line 2. So these 2 questions are new. If you have the 2009 Schedule K, they did not have these questions on them. So this is the first year that these questions are on 2010. Instructions are somewhat unable, but maybe not entirely. And as we go through here, for example, Kim and I have had different views on what goes in specific items, and I think that there are several cases here that I will point out to you. I think there are different ways to interpret these, and as long as you are comfortable with the approach you've taken, you understand which approach you've taken, that's probably the best remedy, as long as you're kind of consistent throughout filling the form out. But there are some of these where there are not answers. Now, the IRS did have a little email address that you could email and ask them questions. Whether any of you have tried that on other parts of the 90, you'd really get an answer. I know that surprises you. It arrives in the mail, and what we got was a whole stack of things that looked like a Lexis search, a legal search, with the word highlighted, but no answer to the question. So maybe time. So part 2, line 1 says retired. Please enter the amount of bonds that have been retired. And so what the IRS means by retired is actually redeemed. Because if you look at line 2, it says amount of bonds legally defeased. So the distinction between those that have actually been retired or paid off, nobody's taking tax-exempt interest on their tax return, versus from your standpoint, they're off the books, but they're still outstanding. And now all you've done is shift where the debt will be paid to a refunding escrow instead of out of your own books, if you will. One of the things that makes it hard to go through the Schedule K is that the IRS seems to be very fond of the concept of cumulative at the end of the 12-month period. And we found that you can interpret that differently. I think that what the IRS wanted was cumulative since the date the bonds were issued, not cumulative over the past 12 months. So in many other parts of your 990, be asking for information just over the 12-month period, but we are, I think, fairly agreed that what they wanted to do here was to kind of accumulate things since you issued the bonds. So for Part 2, line 1, it wants to know the cumulative amount of bonds that you have retired since the date the bonds were issued. So when they look up on Part 1, they're going to see the issue price of the bonds, but now they're moving into Part 2, and they want to see what's outstanding. And so it may be a tricky calculation for you if you have some bonds that you don't consider them outstanding because you've defeased them. You've set up an escrow to pay them. But this would include, for example, if you had serial maturities or sinking fund payments that you'd made on the bond, so you'd reduce the principal amount. So it's cumulative as of the 12-month period selected. And in the Schedule K, you can select whatever 12-month period you want, and it can be different for each one of the issues that you've listed there. It can be different than the 12-month period that the rest of your 990 is on. You just need to be consistent in reporting. If you decide, for example, to pick the 12-month period that's the same as your bond year, so it may be tied to the issuance, pick that as your 12-month period, that's okay if you pick it for bond issue A, it just means that from now on you have to report information on bond issue A with that same 12-month period, so there's some consistency. It's not a goblin of tiny minds, I guess. So let's look at part 2, line 2. Okay, this is the amount of bonds that are legally defeased. And again, instructions say enter the cumulative principal of the bonds as of the end of the 12-month period that have been defeased but not retired for tax purposes. And basically be because you've got an escrow. So let's assume that we have a 2010 issue. We set up an escrow to defease our 2007 bonds, and out of that escrow it's going to pay principal each year until the call date in 2017. So where I had a little trouble figuring out what they meant by cumulative as of the end of the 12-month period. So I think is the principal that you would have, if I paid principal on 2008, 2009, I'm now to 2010, I think the payments from my escrow for 2008 and 2009 moved that principal amount up into line 1 because those bonds are now retired. And what I put in line 2 would be the principal that still needs to be retired. Now, most of you, the amount that you deposited in your advance refunding escrow was more than the principal amount. And so this is asking you for the principal amount, and you may have to separate out, you may have to pull out that escrow agreement and figure out the principal number. It would be possible if you looked at the words and it said cumulative as of the end of that date, that you could view it in a different way, but the retired line and the defeased line you're going to get out of whack. So I think, again, you just have to take what's a consistent approach. So if you decided that once the money paid out of the escrow and those bonds are actually retired, you're going to include that in line 1, then you will take that number out of line 2. If you said, I'm just going to view line 2 as just being the escrow and I'm going to stick with that, then once you pay off out of the escrow, you're not going to go into line 1. Remember I said this was going to be fun. The lesson is that the IRS doesn't like advance refunding anyway, so this is their way of discouraging you from ever doing them or setting up defeased escrows. But I think those are kind of the issue here is the use of the phrase cumulative as of the end of the 12-month period. And that makes some of these other instructions a little bit hard to follow. So on to line 3. Proceeds of the issue. Well, that should be easy. Not really. The instructions say that your total amount of the proceeds as of the end of the 12-month period, no cumulative in it. So snapshot as of the end of the 12-month period, that's the proceeds that you're supposed to put in there. And it says, basically instructions, it says that normally you would expect it to be the amount that's on the 8038 as the proceeds of the issue, which would essentially be the issue price. But it then goes on to say, except if you had investment earnings. Argue that the vast majority of the bond issues you're going to be reporting on had investment earnings. And it says if the amount that you record on line 3 is different than you have to put in donation in part 5. And then it says e.g. investment earnings. So almost all of you, particularly if you do a construction issue, are going to be putting in Part 5, we added, 10, well, at this point, it's probably a really small amount given the investment earnings that people are able to accumulate on even large bond issues. You're going to be putting like $10,000 extra saying this was our investment earnings. The only issues that I could think of where you would actually equal what was on the 8038 would be ones where everything was spent at closing. Some of you may have done, quote, reissuances recently, where we perhaps added an interest rate mode, and you didn't really do a refunding bond. You rewrote the documents to add a mode, particularly a bank held mode, and no cash may have changed hands. So that means that was treated as a refunding. You'll find in the tax certificate it says it was a refunding, and so there everything's paid out at closing, and so not paid out, everything's kind of paid at closing. There's no cash, nothing to invest. If we're to draw down the bond, normally we would expect that there are no investment earnings, because in a drawdown bond you take the proceeds and immediately pay bills with it, pay the construction fund. But a drawdown bond, if you're drawing over more than 1 year, I think the proceeds you may be recording are the ones that you've drawn so far. Maybe you had a maximum principal amount of $30 million, but as of the end of the 12-month period, you may only have drawn 15 of it. Those are some examples where I think even line 3 may be a little bit confusing. Now, it tells you also that the investment earnings that you're going to add to your proceeds, just the investment earnings during the project period, which is essentially the times you're doing construction period. It's going to be interest earnings during that time period. And we'll see some of these other lines. It may be that if you've got investment earnings on, say, a reserve fund or a capitalized interest fund, it may be that you're going to record your earnings on those lines rather than on this line 3. So once I'm done with my project, if I have a reserve fund, I may still have earnings on that reserve fund, but I'm probably going to be recording those in the line that deals with reserve funds. And that's our next line. This one's called gross proceeds in a reserve fund. As of the end of the 12-month period, you should record what's in your reserve fund. And it says the number may differ from the 8038 because of deposits of non-bond proceeds, such as an equity contribution to the reserve fund. In some cases, you may not be able to just go to that line on the 8038 where you record your reserve fund was. Some of the things you would be adding perhaps are investment earnings. And I think what 12-month period you pick may change what's in that number. Most of you probably have the idea of sweeping out earnings at a certain point, or evaluation of your reserve fund on an annual basis, and may sweep it out. But that annual evaluation may be at a different time than the 12-month period that you're talking with your 8038. So you may still have some earnings, so the amount in your reserve fund may be more than what you had in the 8038 line. It may also be that under your documents you take those investment earnings and you pay capitalized interest, or it may be that you dump them into your project fund. And so it may be that those earnings actually are in the fund and you're showing them as having been spent rather than sitting in the reserve fund. So again, I think it's going to depend on how your documents work and when those earnings are transferred out to other areas. But it reinforces that the IRS really is trying to get you to trace what it is that you have that they're calling bond proceeds that they're expecting you to track throughout the term of the bond. one of things that I've seen occasionally are reserve funds that, let's say, did a bank-held transaction, just did a loan with the bank and the issuer, and the bank may have required you to set up a reserve fund with the bank. Your relationship is really very close with the bank. You may not have other funds because no indenture. There's just this three-party agreement between the issuer and the 501c3 and the bank. But in some cases, you've been asked to come up with a reserve fund and hold it, and it didn't come out of the bond proceeds. It came out of your own cash, and so that money may be there. Others of you may have had a reserve fund that was to be built up over time as the project became operational, or if certain events happened, if you didn't meet certain ratios, you were to set up a reserve fund. All of those cases are ones where it wasn't on the 8038 to begin with. It was meant to come out of revenues or cash at a later date. So that would still appear in this line, and it wouldn't be helpful to look back at the 8038 to see if you could find those numbers. Okay, next, capitalized interest. The cumulative amount of proceeds used to pay capitalized interest. And this may be one of the first areas where we run into that the capitalized interest, or the concept of capital costs, capital expenditures, is tax, the federal tax definition of capitalized costs. And in the bond area, it's a little bit different than normal federal tax principles. So in the bond area, you would record as capital expenditures not just when you place the project in service, but the point at which the project was actually operating at the design capacity that you had originally intended. Now, I know some of you have your own debt policies or management policies where there may be some costs that are treated on your books as capital costs. You just write them off or treat them as current expenditures, but the federal tax rules would treat them as capital expenditures. To be honest, you want to put as much of it in as a capital expenditure because in general the tax rules put special additional restrictions if money is spent on working capital, if bond proceeds are spent on working capital. So to the extent that the federal tax rules may allow you to treat more costs as being capital, that would be a good thing on your Schedule K. It's a bad thing because it may mean that you're not necessarily two sets of books, but interpreting numbers differently for different purposes. Some may have funded capitalized interest up front. It may have an identified account, and it may be that you funded it to run to the next interest payment date, and if you placed it in service, say, halfway through 6-month or semi-annual interest payment, it may be that half of that is capitalized interest and the other half would not be capitalized. Maybe that other half, that non-capitalized one, is going to have to appear in the line under working capital. So not set up a capitalized interest account at all, but you actually are paying interest on the funds out of, say, the project fund. It may be a little bit harder to track it, but in this form, they've asked you to kind of separate out what you use to pay interest from the other project costs. Okay. Proceeds in funding escrows. So this says, enter the amount of proceeds held in a refunding escrow as of the end of the 12-month period, including investment earnings without regard to this project period concept. This is the amount from the 8038 unless the amount exceeded the example you had equity contributions. You also have exceeded what's in the 8038 because you had some investment earnings. So this question is worded differently than last year. And last year, when people asked me about it, let's say we did a current refunding on that bond issue. It's our first year to file the Schedule K for that bond issue. So we may have set up an escrow for the current refunding. Maybe we weren't able to pay it on the date of closing. Instead, we had, maybe 30 days where it was invested. It wasn't clear in 2009 whether if you had actually paid off the full amount on closing, and still had on the 8038 had shown we had a current refunding. I put down $10 million as my current refunding number on my 8038, and when I went to file the Schedule K, it was all gone. Did I put $10 million or did I put 0? And the instructions for the 2010 are a little bit better because they say the amount of proceeds held in the refunding escrow as of the end of the 12-month period. So this is one where I think it may still not be as crystal clear as we would like. But it seems to me if you had a current refunding, so at the 12-month period when you're filing your Schedule K, you don't have any money for that current refunding, it's all gone, you would put a 0 in there. But I can see where there may be some who think that you're supposed to take what's on the 8038 because the instructions say it will be on the 8038, use that number unless you've got equity put into it. So in an area where the instruction's a little bit confusing. So into cost of issuance. This one says cumulative amount as of the end of the 12-month period. And I know that they really are looking to see whether you've spent more than 2%. And you'd be looking to make sure that you're not putting down more than 2% on the line also. Most of you will account for and pay costs of issuance at closing. There are cases, as you know, where bills come in later. Sometimes those bills come in at an amount different than was on the closing instructions. Maybe the rating agency charged less, or your bond counsel charged less than what you thought. So you should look at, I think probably what you'd want to make sure of is that whatever trustee statements or wire instructions you have that look like cost of issuance, you're going to need to make sure that that's what you're using for this number. What you wouldn't want is to put a number and find that 2 months later some additional amount was pulled out to pay cost of issuance and you over the 2%. Or if you find that, then we're talking final allocation of bond proceeds so that you can make sure you can cure that within the appropriate time. You want to include the bond issuance costs that are paid from equity. This is only asking you about bond proceeds. Same with credit enhancement. This asks for cumulative as of the end of that time period. Again, in most cases, this will be what was done at closing. You might have gotten a letter of credit and you had to pay an upfront fee. Maybe you paid the first quarter letter of credit. Some of you may have built into your project fund payment of some letter of credit fees that are ongoing ones. If it was bond insurance, it probably was paid all up front. But if it was a letter of credit, you may have some costs that are ongoing. Ballard Spahr, plus I hope most firms, have taken position that if you had a counsel, the bank had a counsel, that those letter of credit fees, those bank counsel fees, would be treated as credit enhancement, not part of costs of issuance. So again, that may be sorting through some numbers and recording them appropriately. Working capital expenditures from these cumulative amount as of the end of the 12-month period, and it says don't include items listed in reserve funds, refunding escrows, issuance costs, or credit enhancement. I think there are like two tricky things about this line. One is whether you treat certain costs as working capital and the federal tax laws would treat them differently. The other thing is very often in your tax certificate we will have put in there that you're able to finance certain working capital costs with bond proceeds under a concept called minimus working capital. So that one included, for example, interest for the later of 1 year after you place the project in service or 3 years after the bonds are issued. And so for rebate purposes and accounting for expenditures for rebate, those aren't working capital. But in the instructions, they're referring to a portion of the regs which doesn't talk about the de minimis exceptions. So you may end up with, for example, some maybe upfront swap fees. The upfront, it says, ignore the credit enhancement, but there may be some interest costs, for example, that end up under this line. Cap expenditures, so this is the cumulative amount as of the end of the 12-month period. Again, it's going to be the federal tax definition of capitalized expenditures. Sometimes where you may have internal people who are devoted, say, to a construction project or monitoring it, or maybe you have in-house architects who are involved in the project. And in many cases, if you're actually tracking their time or the cost of that employee, that under federal tax rules may be treated as a capitalized cost rather than a working capital. And I know that's come up in several transactions that we've worked on. So those costs, if they're capitalized for federal tax purposes, would appear on line 10, not on line 9 for working capital. The other lines. So whatever they haven't thought of. So this cumulative amount as of the 12 months that you have spent on things, not necessarily been able to record in any of the other categories. And the instructions suggest that that would include any proceeds used or held to redeem or legally defease bonds of the issue. So that could be some proceeds that are still in your escrow or sit in your escrow and now have been spent. So actually paid principal and interest out of your refunding escrow, that would be other spent proceeds. They're no longer like capital or working capital. They're amounts that you had as bond proceeds that you've spent. And the other spent proceeds you still have hanging around. This may be, as Martha Stewart would say, a good thing, because often when we go to look at a transaction later or you get the audit letter, we discover that there's money still hanging around somewhere. It may be, $1,000 still sitting in the cost of issuance fund, or $5,000 sitting in the construction. So hopefully this will kind of serve as a clear check to make sure that you don't still have some unspent proceeds that are hanging around from your bond issue. I think probably the main reason you would be recording an amount in here is you're doing a construction project and it's not done. So you haven't spent it on capital expenditures yet. It's sitting in that fund waiting to pay some capital expenditures. Of substantial completion. Now, a couple of lines here where once you get to this one, you will use just copy onto the following Schedule Ks. So this one says if you have multiple projects which many of you do, your substantial completion is going to be when the final one is completed and placed in service. If all we're doing is just a refunding of an appeal, that substantial completion date may be a very old one. It may be 96. It may be 79. If you've done a series of refundings. An easy one. This one you should only have to look at your 8038. 8038 has two lines on it. One is for a current refunding and one is for an advance refunding. Now, some of the, I forget at what point we actually separated out current and advance refunding on 8038. It may be that maybe it's 2003, I don't remember, so it may be that you don't have to worry about that. But look at 8038, find whether you've done a current and advance refunding, and then just check yes or no. And then that takes us to 15 and 17. Has the final allocation of proceeds been made? And this is your opportunity to actually tell the IRS, once you have completed the project, you are allowed up to 18 months after you place that project in service to actually say, this is what we spent our bond proceeds on. So if there's an oops in there, so there was a little too much spent on costs of issuance, but you had equity that went in, you could allocate the equity. If you have a building where you know that you are going to have some private business use in that building, you would want to do a final allocation that shows that equity also went into that building that should be sufficient to soak up any anticipated private business use. So this is really your opportunity to fix what might be some issues that have occurred since you issued the bonds, or to plan ahead and say, well, I'm going to make sure that I show that I put equity into this project so that I have some cushion for private business use. The IRS has not provided a form. I don't know that they ever will, but I'm going to turn this over to Kim to talk a little bit about a form that we've been working on. I think whatever form we would come up with would still be something that you would need to modify because each bond issue is quite different from the others. But it appears as though you'd like to be able to answer yes if you've completed your project. You'd like to be able to say, yes, I've done final allocation, and yes, I have documentation to show that final allocation. So under tab 4, we've got a final allocation, and I'm going to let Kim talk a little bit about that. Tab 4? Yeah.
At risk of revealing that I have been working with the tax aspect of municipal bonds for long enough that I have a warped sense of joy, I absolutely love final allocations, and I love putting together this schedule because it allowed me to kind of go through and think of all the things that come up after the fact where we don't know exactly where we put bond proceeds. We know we spent it on this hospital project, but we're not sure which floor maybe we spent it on. I think that a final allocation, not only is it technically required, but if that's fairly specific, it will provide you with a roadmap for ongoing monitoring of private use. In the form, we have kind of the sources and uses that laid out so that you can put the funds down that is your final allocation to the types of line items that Linda just talked about to help you fill out Part 2 of your Schedule K. We also provide a post-issuance compliance checklist. If you kind of through that, it will give you a chance to maybe confer with counsel and figure out whether or not you should actually talk to counsel before doing a final allocation. And we also provided an Appendix A, which is sources and uses where you break it down by project, the amount of proceeds spent on each project, other sources of fund might have used for that project, a placed in service date for that project, and the expected useful life. Having something like this going forward makes it so much easier to come forward and say, I'm going to lease out a floor in a building. If you had this sheet of paper, it would be easy to then go and determine what bond proceeds are spent on it, whether or not it doesn't even matter because you only spent $10,000 worth of a $100 million bond issue, so go ahead and lease all you want. I find that having something like this makes it a lot easier for counsel and refundings. It makes it a lot easier for your compliance people to comply because you actually know exactly where the money went. It also provides a record of the final average economic life to make sure you're in compliance with 120% test. And so I think is a good first step in showing that you are making a good faith effort to monitor ongoing compliance. If you were to be audited and you had a nice form filled out with all this information, you look like you're really paying attention to what's going on, and I think that goes a long way in showing good faith. Definitely suggest taking the amount of time that it takes at the end of a project period to fill out something like this, rather than wait 5 years. Maybe the facts are less clear at that point. Maybe you're already in a situation where you might be leasing or entering into a new management contract, and at that point it's much harder to recreate what happened than it would be if you just did it, took the 5 minutes, 5 hours at the very end of the project period. So we definitely recommend that.
We're coming to a point now where we'd like feedback. I'll ask the first question, and then I'll answer it myself. But I hope it will be a basic question that would inspire other basic questions. There's a word here which is utterly unknown to people not in business, those of us as financial administrators or lawyers or investment bankers. The word is defeased, D-E-F-E-A-S-E. And I think I ought to attempt a definition of that because it's come up several times yet this morning. Defeased means putting up money. I guess Linda said pretty much this too. Putting up money in an escrow, as a fund, pay the debt service on bond issues. And if the money is there to put up the pay the service, then the debt service doesn't have to be paid out of project revenues. This is a Norman French word which was brought into our language when the Norman Knights invaded the British Islands 1,000 or so years ago. And it means not to defeat the British, but it meant to defeat the lien, L-I-E-N, another Norman French word, defeat lien of the indenture, yet another Norman French word, on this project. All these words are Norman French. When the Normans invaded and conquered England, they imposed Norman French law on the inhabitants of the British Isles. That's why so many of our words in this area of law are really ancient French words. Now, that is a running start. Let's look for some questions. And we're going to start with the live audience here in Philadelphia with manual and digital motional signals, waving your hand, sticking up your hand. Would anybody like to ask a question? And I urge, we would welcome questions that say, at this point or that point, we understand that all what you were talking about. So please give us a good question to help us go back over things and clarify them. Anything in this room, and if not, we'll move on to other rooms.
I was thinking about we talk about capitalized interest, and we normally think of that during the construction period only, but you mentioned a term called bringing it to the design capacity. And why would you have to worry about that as opposed to using the standard accounting definition?
I don't think that you would have to use the more liberal, it's actually more liberal definition. repeat the question. Okay. So the question was, what would you use the definition of interest through the design, capacity definition instead of the traditional tax definition, federal tax definition of capitalized interest? It's simply a more liberal view of it. And so normally when you're figuring out how much you're going to capitalize, you aren't sure because you don't know when the project's going to be placed in service. And there are instances where we get towards the end of the project and there's still money left and was intended to be used for interest. I know it's not common to have the projects finished before you expected, but occasionally you end up with, for example, too much in a contingency fund, and so maybe you want to pay some additional interest of that money. And so it's a more liberal definition, and liberal is good.
Are there any questions in our Phoenix office? And let's see, I guess if there are, and you speak them loudly, then by magic, you will appear on our screen here. Well, are there no questions, or they're not speaking them loudly?
Sorry, no questions, Rick.
Okay, that worked.
Was it, or?
No, she said there were no
No
questions.
questions, all right.
I have a question. Can I ask a question? Sure, never mind, we do have a question. When you were going through the difference between retired and defeased, are the retired and defeased always equal your total proceeds? So as you are paying your principal payments, that's moving up to retired?
Did you count?
Yeah, I think it depends on the kind of investment earnings concept, because in some of those lines, like line 1 and 2, you're talking about principal, but you put into your refunding escrow, particularly if it was an advance refunding, you've put in principal, you expect to have earnings sufficient to pay down, to pay interest that accrues until the call date too. So I think it depends on one of the lines you're filling out. And I tried to do kind of a back of the envelope calculation and concluded that they might not add up.
It would really help this section of Schedule A if numbers that were entered in Part 2 were to total up to something. Then you would kind of know, you'd have check back on what you were doing, but they do not instruct us to total them to anything, which is why we have trouble figuring out exactly what line items, what numbers to put in the different line items. How about in Salt Lake? Any questions in Salt Lake? Well, I think you see sort of the drill. How about Baltimore? Any questions in Baltimore? Questions?
Yet. She's
Not yet. Oh, okay.
She's reserving.
Reserving, all right. No questions at this time, I get it. Well, now, Wilmington, Los Angeles, well, I guess that's everybody. How about Wilmington, Los Angeles, or Baltimore? Can't forget Baltimore. Okay, I'm going to try something that I really have the willies about. I believe you saw Oz appear from the screen to repeat the questions. There is some way that people who are listening on webinars can ask us questions by typing into whatever the page or whatever slide we're up to. And so I ask those on the webinar transmission, type in a question or two, and I ask the great and powerful Oz, sneak out and tell us if anybody does so. Questions yet? Well, let's take a little bit of a break for maybe 5 minutes, and then we'll start again. I'm going to walk around, and I hope you all will too, but we'll start again at about 10 minutes after 2.
interesting anything. In fact, it needs, I think it's over there, and the initial instructions say you can put outstanding 100,000 and more outstanding. Okay. So if it's issued after, 2002, but you don't have even 100,000, then you don't have to give them back the report. So that wasn't that much. It was a good one. We had a bond issue in 1999. But it wasn't paid off until 2009. Right. So you would have still been showing 2004 and say would have been fees. And now if it's on, it's not going to be on the form at all. And then the other thing, but what if that sweep is at a different time, maybe 12-month period or covering? So if you do the sweep on December 1st, but you run the numbers in June 30th, it may be that you would show, maybe it hadn't been swept by that point. You might have accumulated
Oh, we're going to start up again, but for people at least in this room, if you want to go back and grab a cup of coffee or anything in the back, there's plenty of it there. Now, where are we? We are on the slide 16 and 17. We want to go one forward, part 3, line 1. I'm able to resist one more excursion into the world of Norman French law. The word indenture. This one, you're pretty good. You already know it. Where's that word come from? That comes from the Norman French word for teeth, which was reflected in our word for false teeth, dentures. What it refers to is that in the old days, before Xeroxes and all that were invented, if you had an important document, you'd make 2 copies of it on one side of a piece of paper or down the 2 columns. Then you would perforate it by chomping on it with your teeth. Rip half, give 1/2 to each party. If there was ever any question about the veracity of the document you put together, if they fit, you knew you had the right document. Occupation of, well, people like me, who in their living reading indentures.
What if they didn't have teeth?
You would find a vassal who did.
So the dog ate my paper, my homework was.
That's what came from, that's right. All right, now we're going to get a little bit more into the use of proceeds section of the form, which begins to be where I think a lot of the real bite on this idea that somebody inside the Internal Revenue Service is going to look at these forms and look for answers that they think should be different for any reason. This part of our program, the discussion leader is going to be Kim Betterton, to my right in this room, or I guess the rooms where we're just sort of disembodied voices, it doesn't really matter right or left. But Kim, take it away. Part 3 on 1, the slide that's up on the screen.
Part 3 covers private business use. Just as with Part 2, Part 3 can be really tricky if you don't read the instructions carefully, because the questions might seem to have obvious common sense answers, but the instructions point you in a completely different direction. I'm going to try to move through these fairly quickly, leaving you with a couple takeaway points for each line item. The first item asks about whether or not you were a partner in a partnership or a member of an LLC which owned property financed by the bonds. In order to answer yes to this question, you have to be a partner in a partnership or a member of a limited liability company which both owned property financed by the bond issue and included as a partner a member a partner member that was an entity of a 501c organization. This should not be applicable to issuers or borrowers of qualified 501c3 bonds generally, because if you answer yes, you will have violated the ownership requirement applicable to 501c3 bonds. However, Linda has a scenario where certain borrowers should answer yes.
And I'm not sure whether it would occur for any of the people in the audience, but it is not uncommon for a 501c3 set up to provide low-income housing to enter into a partnership with a for-profit entity in order to get low-income housing tax credits. And very often the 501c3 will be the general partner. And while we've been talking about the Schedule K as covering 501c3 bonds, the instructions actually say that it is any form of tax-exempt bond. And there may be other types of bonds that a 501c3 issues that are tax-exempt but not C3 bonds. But for this particular question, unless you're in a low-income housing tax credit project, you would be checking no.
Part 3, line 2 asks whether or not there's any lease arrangements that may result in private business use of the bond financed property. Also seems fairly straightforward, but what about a short-term lease, for example, the rental of facilities for a one-week camp over the summer, or a one-day aquarium? There are situations that might be considered a lease, but I don't know that you'd necessarily want to answer yes to this question. I'm a little bit torn on it because the instructions do not specifically say to include leases that have been determined to meet a short-term exception to private business use. For now, I would say not to include leases that meet such a short-term exception, but include things that you would think of more as a real true lease or something. And the reason I am torn comes up in this next section. Are there management or service contracts that may result in private business use of bond finance property? The common answer would be that to the extent that you thought that you had one that complied with a safe harbor, you'd say no, you don't have any contracts. However, specifically in instructions, it says for this purpose, answer yes, even if the organization has determined that the management or service contract meets the safe harbor under Revenue Procedure 8713 and will not result in actual private business use. So basically, they're just asking you if you have any management contracts, and you need to answer yes if you have any management contracts, regardless of whether bond counsel or anyone determined that they met the safe harbor. Line B, similar, but it's asking now about research contracts instead of management contracts. Again, the instructions state that for this purpose, you need to answer yes, even if the organization has determined that the research agreement meets the safe harbor under Revenue Procedure 2007-47, formerly 97-14. So if you have any research contracts, I think you need to answer this question yes. Linda wanted to quickly discuss tracking of research contracts.
I know that this is the bane of your existence for some of you, trying to track the research agreements. I have 5. We've got a summary of the management contract rules, and then following that, we've got a short discussion on tracking sponsored research. Keep in mind that the IRS expects that you are keeping all kinds of documents to prove your position that you're taking on the 990. We thought it'd be helpful to provide a format that you might use for tracking the research contracts, and it's not just tracking them for whether you think they fit within the safe harbor or not, but also is if you determine that they are not within the safe harbor, they involve some type of a special use of any product developed as a result of the research, then you have to be able to respond with how am I going to measure that. And in some cases, particularly at universities or teaching hospitals, it may be that research takes place in a laboratory that's only available for research, some of which may be good and some of which may be bad under the management or research contract rules, or it may be that research takes place in a lab where the majority of the time is classroom time, part of your teaching function. So you need to be able to document those types of uses so that when you go to figure out, do I have any private business use, you will have some kind of a tracking form. As I said, this is just one possible way to do it, and we'll be talking as we go along with other ways to track private business use.
Now, Mike, a comment that is not derived from the law 1,000 years ago. We've dealt with 3 potential private interests in facilities financed with 501, tax-exempt 501c3 bonds, and have them here in the order that they appear on the Schedule K, but we also have them somewhat in order of difficulty in dealing with. The easy questions to deal with usually revolve around leases, is it or not, and it's relatively easy, I think, for an organization to have internal monitoring on leasing property. It's a very significant standardized transaction, and one can identify when it's happening. Management contracts is a little harder. There's a lot more law on what is a management contract, whatever management contract, what sort of slips below the level of management contracts and the classic example, is a contract for janitorial services. The regulations say that that's not a management contract, it's an incidental use of the property by the janitor. It's a little bit of a stretch, but that's what the regs say. I think the use contracts, I think most people think don't have to be, don't for reporting on line, whatever it was, line 3A something. The great problem area for large institutions of health or higher education tends to be research agreements. Our experience has been that within an organization of this type, there is a dedicated, strong-minded, intelligent group of people who administer these wonderful programs that bring dollars that are invaluable, perform socially beneficial research, and really carry out the mission of the organization. And some tax lawyer gets in a room, someone like me gets in a room with them and says, now we're trying to figure out whether these research contracts create private business use because the other party is either a private corporation, a business corporation that's sponsoring the research, or maybe even a federal government agency, and that might mean that the federal government is using the facilities by way of the research that's being done there at its request. Talk about a kind of a gap in language and communication, and there you've got it. This is difficult for us. Our best route is to ask, could we look at some of them and make sure that they don't seem to be giving over the store the contract party, the party that is sponsoring the research. We also look and see if the contract party, the sponsor, is a federal agency. Thanks to the newer of the revenue procedures we've cited, the one from 2007, I think most of us can figure a way to get pretty comfortable pretty quickly that contracts with federal agencies do not create a private use, classifying the feds as a private user if the contract did create a private use. But reading federal research contracts, I have found one of my more difficult challenges as a lawyer, mainly because they go on and on and on with appendices and addenda and restatements, and it's always very obvious to people who know what they're doing exactly what it all means. But to a bunch of tax lawyers, it's very hard. So this area, if this area is frustrating for you, it's doubly so for us. End of sermon. Kim, back to you.
3C asked whether or not the organization routinely engages bond counsel to review management contracts or research agreements. To note in the instructions they really want to know about the tax year. So if you routinely engage bond counsel because they assist you when you do a bond issue, but you didn't happen to issue a bond issue that year, unless you specially engage someone to review, I think that you'd have to answer no. Another item to note is if you didn't have any research or management contracts, the instructions note, in other words, if you check no in line 3A, then you should also check to leave this line blank, because it means there wouldn't have been anything to review. That points to how they want to know about whether you have private business use contracts.
And we did not cause this question to be put on the form. It's a terrific question. We didn't complain about it, but we are not the reason that question is on the form.
Line 4 asks for the percentage of finance property that's used in private business use by entities other than a Section 501c3. There's a couple things in the instructions here. First, they want the average percentage over the not a snapshot at the end of the year. They also do not want you to include any cost of issuance reported in Part 2 in line. They are asking only for private business use that results from entities other than 501c3 or state or local governments using the facility. Therefore, anything that's business use due to unrelated business income activities would be added into a percentage on the next question as opposed to this question. I think the cost of issuance is particularly key to keep in mind, because if you reported the issuance here with your business use, and you additionally reported that you paid some cost of issuance from bond finance properties and bond proceeds in Part 2, it might look like you have more private business use than you actually do. Line 5, again, the average percentage, so it's not a snapshot, but it's measured during the course of the year, of property financed by the bond issue that's used in unrelated trade or business activity of yourself, other 501c3s, or state or local governments. Again, this line only wants the unrelated business income, private use, and shouldn't be aggregated with cost of issuance or management contract or research agreement private use. Line 6 just asks for the total percentage from line 4 and 5. So basically line 6 should be your overall average private business use for the reporting year, but not including your cost of issuance. A couple items to note here. If your roll on loan is over 5%, you should probably have an explanation of why that's okay. For example, if you know that you had your bonds that have been outstanding for several years and you've never had any private use, and in this 1 year you had a bad lease, they gave you 10% price, but you knew that this lease is only 2 years, and then going forward, you weren't going to have any private use, so the average over the life of the bonds would be fine. You probably want to tell them that you had a plan for that rather than just show up with something that's over the limit without any explanation. I don't know if you guys have anything to add on that.
Yes, I agree with you totally, Kim. That's not too surprising since we're partners in the same law firm. But I think to answer this question with a percentage like 6 or 7% and just not say anything more is going to trigger a question from the service if, and it's almost a when, someone in the service looks at it. And they'll call up and they'll say, you're aware that if you change something, these bonds will be taxable, and we just have an answer ready, and the answer would be, no, we bought a building and it had private tenants in it, we couldn't get them out, we're trying to get them out as fast as we can, we're bringing the private use percentage down as quickly as we can, and if we can't get it below 5% on the average, we'll send in the campus cops to drag them out or something like that. We have a plan, got to have an answer.
I think you also need to be very careful about not reporting conflicts in those numbers, because then they'll probably go back and add it back in and make sure that overall is under 5%. Moving to line 7, has the organization adopted practices and procedures to ensure the post-issuance compliance of its tax-exempt bond liabilities? It only wants you to answer this question with respect to the tax year applicable to this schedule. So since if you got around to preparing your form or Schedule K for 2010, and you had already applied for your extension, and you just now put procedures in place, could you count those? It does say only answer it with respect to the tax year in question. I think that this is just a personal opinion, and Rick and Linda can disagree, that if you follow your tax certificate, that for this particular question, you can probably answer yes, if you're in a habit of following your tax certificates, because it might be considered the adoption of management practices. A lot of questions on various forms that, for instance, the Form 38 now, the Form 8038G, the draft 2011, okay, are starting to use a different terminology, such as written procedures, and I'll go into describing why when they start talking about written post-issuance compliance procedures, I think they really mean something separate and apart from your bond documents and your tax certificate.
Now, we would say that at this point in the year 2011, 2011, the service published a draft of the 2011 Form 990, including the 2011 Form Schedule K, which would be due at some point in 2012. And this question is much more pointed now. It reads in a draft form for 2011, has the organization established written procedures, can't be practices, it's supposed to be written procedures, to ensure that all the non-qualified bonds of the issue mediated, and that's made good, in accordance with the requirements under regulations, citing Treasury regulations. Remedial means if you find bad use, you do something to remediate it. We'll be wandering in and out of that reg as we go forward here, but that's a pretty in-your-face question. Pretty tough to answer that one with a no. Feeling a little bit warm and uncomfortable, I fear.
It actually now, the 2011 Schedule K has 3 separate questions asking about written procedures, the various types of written procedures for, I think, arbitrage compliance, you can correct your problems in time, and I forget what the third one is. Rick has it right there. I think one thing we want to stress is the IRS clearly wants written post-issuance compliance procedures, and here and in the outline I might refer to them as PICs. They've systematically been adding these questions to, it's now on Form 8038, the Schedule K. They just recently, within the last couple of weeks, added it to Form 8038G. It's on various other tax-exempt bond filings, and some of their post-issuance compliance questionnaires also specifically ask about various types of written procedures. Draft 2011 Schedule K has 3 separate PIC questions, which all specifically ask about written procedures rather than just the adoption of management policies. IRS recently changed the Internal Revenue Manual to make VCAP more favorable if you have written procedures in place, and Rick will discuss that a little bit later. The thing the IRS did this year was they put out their report on the results of the 501c3 post-issuance compliance questionnaire that they sent out in 2007. They did that while almost all of the respondents reported they had written procedures for post-issuance compliance. The IRS determined that only 15% actually had formal written procedures. They suggest that following a tax certificate on documents was not enough to qualify as formal written procedures. Also noted a concern that 501c3 organizations were not devoting adequate resources to ensuring compliance on an ongoing basis. What should PICs cover? One does not fit all. We have provided among procedures for qualified 501c3 bonds in the workbook. The attempts to incorporate everything that I will now go on to describe. It's the third document behind tab 5. For large organizations, we have also provided a form questionnaire that could be sent out periodically to the various departments of an organization that might be responsible for bond finance facilities. And the department questionnaire is the document behind tab 5. Since I know that there are some on behalf of issuers listening, the model that we've provided does cover qualified 501c3 bonds, and if you are an on behalf of issuer issuing governmental or other types of bonds, these procedures would probably have to be modified to suit your type of bond. Go ahead.
Well, relevance of these questions to the issuer as distinguished from the borrower is of intense theoretical or practical debate. If an authority does a financing for a hospital, the Form 90 asks the hospital, do you have post-compliance PIC procedures? But the Form 8038, which the authority will file, asks essentially the same question of the authority, So the authority will therefore want to create its own procedures, or else in some way or other back onto the borrowers. So anybody who does a tax-exempt bond financing in the current environment is to learn more than I think they would ever want to know about the law and lore of PIC.
One thing that we did include in the model was a paragraph concerning delegation and keeping records of delegation. So these are in the borrower form right now, but they could be modified for an issuer. And then the issuer would use the delegation paragraph, presumably saying that it delegated all of the following to the borrower. IRS has become concentrated on who is responsible. There should be an emphasis on individuals rather than departments. And I believe that the concern is that if a whole department has the responsibility, everyone will think that it's someone else is actually doing it. Another more recent IRS concern is whether or not the people are being properly trained. They're focusing on whether the responsible individuals are being given access, making sure that they have access to records, for instance, making sure that they have all the relevant materials that they would need in order to ensure compliance, whether or not they have access to webinars such as this or other free webinars put on the IRS or website about ongoing compliance, and whether or not there's reference materials. Those are just examples of things that you might want to do, because if the person responsible is just sitting at a desk and they don't have any of the tax certificates and they don't have a final allocation, how are they really going to be responsible? The thing that they've become focused on is having a time schedule for various types of monitoring or review. It's important because it allows the borrower to recognize and correct violations in a timely manner. This is another thing Rep will cover in VCAP. Basically, the VCAP rules have now been changed so that if you correct for error within a certain period of time, you get more favorable treatment. So if your procedures aren't set up so that you're routinely monitoring, then it's possible that you, even if you discover an error, won't get as favorable treatment if you discover it well after you should have, if you've been monitoring timely. Retention policies just think that you are considered guilty until proven innocent when it comes to tax compliance. So if you do not retain records to prove compliance, an audit will be likely more onerous and expensive. The compliance to monitor. Again, this is more towards 501c3 bonds. It's a limit on cost of issuance. So again, if expenditures come in after closing that bond counsel hasn't monitored, you need to make sure that you're not requisitioning for cost of issuance and then blowing the 2%. Make sure that to the extent there are project changes, that they still fall within the TEFRA approval. Enforcement of expenditures that were made before the bonds were issued is proper and complies with the tax certificate, the official intent rules, et cetera. Obvious exempt use and ownership. Proper investment and yield restriction of various funds and accounts. Rebate money is paid on time. Recently, it became clear the IRS also wants to make sure that people are using advance refunding properly and actually have procedures in place to ensure that they're using advance refunding properly. In the model procedures, we have included a section discuss how you might go about making sure that you're only doing, quote, proper advance refundings. Why does the IRS want post-issuance compliance procedures? I believe from everything that I've heard from them and looking at the various materials and reports they put out, that they really believe that properly drafted and enforced compliance or timely use of remedial action or timely use of VCAP. Further, I'm interested in record retention, again, because it makes proof of compliance easier in either the audit or the refunding context. As discussed, we provide a model form as part of the seminar material. should you adopt it if you cannot follow it? I believe that rote adoption of policies might allow you to check yes boxes on various IRS forms. However, it is better to adopt policies that you can actually follow. That is why what we provided is simply a model. Your procedures ultimately embody types of monitoring that you can live with, but that will also meet compliance and timely correction goals. Unless Rick or Linda has anything further on this, I was going to turn it over to Matt Duke of Avant Strategic Partners to discuss Part 4, arbitrage.
Well, just one point of transition here before, get ready, but we're just one point of transition. Put yourselves for a moment in the position of the Internal Revenue Service, and you can really see why post-issuance compliance procedures in writing are so important to them. They mean that you are sent out by a superior whom you wish to please by the quality and quantity of your work, and you're told, please audit the bond issues by this huge healthcare system or university or whatever. It becomes very deal easier to develop what they call an audit plan. The entity has a post-issuance compliance procedure in writing, because then you as an auditing agent can take the plan and go through it paragraph by paragraph and ask them, well, it says here you were going to do this once a year. Did you do it? Sort of see how that would work and why it might be a way for them to deal with the problem of auditing these huge, immensely complicated actions. So post-issuance compliance is definitely here to stay as a sort of goal in the Internal Revenue Service, and I think they have no lack of ways to make things unpleasant even more for people that don't have a compliance plan. Now, with that sort of segue, we're going to talk a little bit now. Our discussion leader for the next part of our presentation will be Matt Duke, who will be speaking over the video conf hookup from our Los Angeles office. Matt is a senior manager in a firm which is affiliated with Ballard Spahr. The affiliated firm is Avant Strategic Partners. Ballard Spahr is a limited partner in Avant Strategic Partners. They are not a law firm. They are financial managers. They do rebate calculation. They do post-issuance compliance work, particularly in terms of record assembly, record maintenance, helping, just helping us, but helping clients. That's why we did this into presentation this year, whereas when we did the same presentation or presentation on the same subject 4 years ago, we had the affiliation all right, but it didn't quite occur to us that it really would be more effective as a joint presentation. It occurred this time, and it is. So with that introduction, take it away from LA, please.
Thanks, Rick. Appreciate the introduction. I think the intersection between our firms really brings together pre-issuance aspects, but where we come into play, and I think we can add some value, and we'll talk about that later, is how do you execute all of this without going crazy? So we'll leave that for the next section, but I'm going to cover Part 4, the arbitrage section, which is fairly straightforward, I think, but there are a couple of nuances that we'll highlight. The first one seems like a pretty straightforward question. Has a Form 8038T arbitrage reduction and penalty in lieu of arbitrage rebate been filed with respect to the bond issue? It seems like it would be pretty black and white, either did or you didn't. I hesitate on that because recently the IRS has actually suggested they are in the middle of an initiative to draw from a pool of 2,000 bond issues which never filed an 8038T. so presumably if they didn't file, it's because they had their calculations and found that they had negative liabilities. So the question at face value seems pretty simple, but it could be tricky. And I'd like to get your take on that, Rick. Is this a question where if you answer no, does it put you in a bad spot for an audit?
Well, not, because I think the law is crystal clear, you might say, as clear as anything we've talked about in this session, that if there is no liability for rebate for the other things in this question, if there's no liability for rebate on the 5-year calculation date, there is no duty to file a Form 8038T, which you did file it, which would just have a bunch of zeros in it. You're not required to do that. And, could there really be, is this question going to put pressure on us to a piece of paper that's of no relevance to anything, doesn't carry a payment, doesn't have figures in it that relate to anything? I hope not. I hope it's just an innocent, open question. Have you filed a form that had filed it and we had perfect record keeping on our side of the table, the service might say? We would already know about it because we have the form, but we want you to help us perfect our record keeping. Maybe that's all it means. I don't know.
Okay. Number 2, is the bond issue a variable rate issue? I think that's pretty straightforward, and you can look at your original 8038 that was issued, and you want to make sure that you match your 8038. This probably has something to do with 3D, and we'll talk about that in just a second. 3, has the organization or government issuer entered into a qualified hedge? And I think the key term is qualified. So if you're unsure as to whether or not you have a qualified hedge, you should ask your arbitrage analyst or your bond counsel to be sure. But generally what we'll find is that the hedge will be identified to the bonds at issuance, and there will be a lot of language in the tax certificate talking about how it does qualify as a qualified hedge. Now, C is the name of the swap provider. C is the term of hedge, and the term of hedge is in years and tenths of a year, not months. What hedge super integrated? And so essentially, if you have a variable rate issue and you have a swap, a qualified hedge, you can super the swap so that the bond issue is treated as a fixed rate issue. And generally, on your original 8038 filed, you should be paying a fixed rate if it is indeed super integrated. Was terminated? A lot of the turmoil that happened a couple of years ago, there were a lot of hedges that were terminated due to bankruptcy of the swap provider, and in some cases there were deemed terminations. And again, that's something, if you're unsure of how to answer that, you probably ought to rebate analyst or bond counsel, because they will definitely know. Proceeds invested in a GIC. The IRS has spent a lot of time looking into GIC providers and how the process executed as far as entering into a GIC, and you'll see this question all over the place in their forms. Simply, you want to collect it's either yes or no question, and if yes, the name of the provider, the term of the GIC, again in years and tenths of a year, and the fourth is probably the very important question of was the regulatory safe harbor for establishing the fair market value of the GIC satisfied? We want the answer to be yes, but it's not always that simple. And a lot of times it's hard to get bidders to on your investment. And Len, can you speak to what you do if that is the case? If you can't follow safe harbor, there just aren't enough bidders. How do you document that well?
Yeah, I think you would end up, if the GIC is done at closing, you would probably end up with language in your tax certificate that describes the procedure that was followed. You might have gotten an independent party to verify that the rate on the GIC was a market rate, or you might have compared the rate to the state and local government series of U.S. Treasury securities that are available. But all of those kind of explanations would be included in the tax certificate.
Number 5, were any proceeds invested beyond an available temporary period? This is something that if you're outsourcing your arbitrage compliance, your arbitrage provider can give you a very quick and simple answer to that. Generally, for if you have a construction bond and you're beyond the 3-year temporary period, if there's a very good reason for that, you would want to explain that in Part 5. And then number 6, did the bond issue qualify for an exception to rebate? Something in today's world where there's really no opportunity for arbitrage, your rebate analyst may just skip over testing for the spending exception, because if you qualify for the spending exception, you don't necessarily have to apply it. It's beneficial to apply it if you meet the spending test and you earn positive arbitrage. So this is one where you actually be qualifying for a spending exception, but the rebate analyst hasn't applied, and that's something you can ask the rebate analyst for clarification on. And then 5, again, that's it's not in slides, but it's something that we're going to use to explain nuances to our answers on other parts of the Schedule K. And I think you were going to talk about remedial actions in VCAP.
I'll start by reading the 3rd posted compliance question that we knew on the 2011 form. This is the 3rd of the 3 questions that Tim referred to, and I think it is late enough in 2011 now so that we can be pretty sure this will be on the 2011 form, filed in 2012. The question is supposed to be answerable by accounting or financial executive at a 501c3, but it's written by people like us for people like us, and it's not in language that makes much sense except us tax lawyers. Has the organization established written procedures, that part's pretty familiar now, to ensure that violations of federal tax requirements are identified, okay, so far, and corrected through the voluntary closing agreement program if self-remediation is not available under applicable regulations? Now, what are they getting at with that self-remediation? That sounds pretty good. You will remember that this notion of remediation has come up before in presentation, and it's been in the regs for some time. The classic instance of remediation or self-remediation comes in something that's very common, very important, and in cases painful but necessary. It would be exemplified by a hospital which has 6 facilities, 6 campuses, and a hospital system, and it decides that it only needs 5, so it closes one and sells the property to a private party, either a private medical care healthcare chain or a private developer for whatever. That was financed with bonds. We now have a so-called violation because we have a private use of the facility. We can do 2 things to remediate. Just like remediating environmental harm through spilled oil, we remediate private use from selling facilities. Now, who's got a magic wand? All right, on to, oh, somebody did it already. Okay. I'm the author of this slide. It's the only slide in the presentation that wasn't written by either Kim or Linda. Or Matt. Sorry, we haven't gotten to Matt's yet. We assume in this slide that we sold a facility and that the facility was 30% of the bond proceeds. We therefore have non-qualified bonds of 30% of the issue. There are two things we can do, and you may think it's pretty silly to have two choices so close to each other. One is the remedial action under the regulations. We just do it. We don't have to go talk to the service about it. We just do it. If we sell for cash, we take the proceeds of the sale and use them. Hey, here comes my favorite word again, defease 30% of the bonds. If for some reason we don't do that in time, we don't comply with the regulations in any particular respect, is we go for what we all call VCAP, the Voluntary Closing Agreement Program. This is an effort by the service to be helpful. On the other hand, it is unpleasant in some respects. It requires the party seeking a voluntary closing agreement. Voluntary meaning we're coming in asking for help before they caught us, before they found us. In that sense, it's voluntary. We must admit in writing that we violated the federal tax laws. That particular aspect of VCAP has been unpleasant to bondholders and to conduit borrowers, 501c3 borrowers alike. Nobody likes to admit in writing at a time when you go to confront your sovereign and plead for mercy. No one likes to admit in writing that you have violated something. I think it's easier for everybody to plan ahead, use a remedial action on a timely basis, and move forward on that in that way. If we go in for VCAP, we have indeed published this August a so-called resolution standard, which is a guideline as to how they will deal with these cases. And it's really pretty similar to the remedial action standard. They say that we pay taxpayer exposure, meaning the amount of tax they would have collected under open periods of limitation on the bond interest if it were taxable at an assumed 29% rate. They pulled that out of the hat some years ago. Taxpayer exposure on, in this example, 30% of the bonds to the call date and defease any bonds that would mature after the call date, defease them to the call date. It's really pretty close to the remedial action, and I think no one would. I don't think there's a particular financial advantage one way or the other. I think people will get into remedial action if some technical reason or because they didn't discover the problem in time. It's seemingly unlikely with a major property sale. They're able to use the remedial action regulations. One other reason that's available under the remedial action regs, in addition to defeating the non-qualified bonds with the sale proceeds, and that's to take the sale proceeds and plow them into fresh qualified capital expenditures. That is the one that I've seen in my practice is the most popular with 501c3 entities, because it allows them to preserve the benefit of the tax-free financing and just move the proceeds over to new qualified costs. VCAP is administered by a special kind of a branch in the service who are different from the people that conduct audits, and they are different from the people who write rulings, and they're of course different from those of us in the private sector who administer the remedial actions regs. So it's kind of a four-ring circus, and one has to pick whichever and make clear in the VCAP regs that you will get a better deal from them on the settlement compromise under the closing agreement, which usually involves payment of some amount of money, such as the taxpayer exposure amount here in this example. You will get a better settlement deal if you have a compliance procedure picked up violation. If you had a procedure that didn't pick up the violation, it's not going to do much good, but they're putting a carrot out as well as a stick on this one. Like they say in the network news, you on this fancy leveraging technology to manage compliance.
As I mentioned earlier, the goal in all of this is trying to manage all of the moving parts and make sure that we're retaining all of the records we need to fill all of these forms and whatnot. And a double-edged sword, I'm going to use the caveat of a double-edged sword, is technology. Because I've seen very good uses of technology to manage compliance, and I've seen very poor use where it disrupted the organization a lot. And one of the common themes in the good uses of technology is the use of a content management system. A management system can mean a lot of things to different organizations, and it depends on size and sophistication and culture. So I'm going to try and highlight some of the best features of a typical automated content management system, try and describe the application to post-issuance compliance. So the bullet there talks about we have a lot of documents and records to retain over the life of these bonds. And as an arbitrage analyst, some of the toughest assignments have come where we're doing a 50-year or a final arbitrage report on a bond that was issued many moons ago. There are no trustee statements readily available. There are bond documents are difficult to come by. And this is an instance where I think technology going forward will help that tremendously. But we have to know how to use the technology easily. Because if we use the weapon analogy, a weapon can be used for good, but it can also blow up in our face. So the content management systems that I've seen basically store documents as you would on a shared folder or shared drive on the organization's network. There are some enhancements to that provide search capability, kind of like a Google search, and also it provides some cross-linking and referencing to other relevant documents. So in the great sea of all of our bond documents, we can link those together when we set them up in our content management system so that they're at the fingertips. Web-based access, this is one highlighted because I think it's very relevant for conduit issuers. I've seen conduit issuers who take a very paternalistic approach to their conduit manage. And when you're a conduit issuer and you have multiple parties outside of your own organization that need to share documents and share records, having that web-based access is a very key feature. Check in, check out of documents and version control. This is really important when in a document repository, a troop repository, it's checked in as if it was checked into the library. The software, the application, manages who's got that document checked out, and when used in conjunction with workflow capability, I think this is really going to hit on the IRS's desire to assign ownership and to follow through on the execution, so that essentially we know, for example, a policy can be written, put on a shelf, and it can collect dust for years. But we can use automated technology to assign an owner to that policy and an owner to the procedures. And the application or our content management solution also sets up due dates and timelines where certain tasks or activities must be performed. It provides a lot of compliance activity from going down or through the cracks. The important thing about workflow capability as well is you can set up ticklers to assign responsibility, and you can delegate several layers down. It needs to happen once a year. or once a quarter, you can assign that task through your automated system to an individual, and you can report on whether or not that task has been completed, all within the system. The last one there, robust reporting, again, is also next slide with this. We have provided a lot of form documents for things such as final allocation of proceeds and spending tests and such. If they're automated into your system, they're going to be easier to track. You can assign workflows to them, and you will get much more efficient. And when I say efficient, think less dollars involved in managing the overall compliance function. And, thank you, Kim. Go ahead. And that's one of the things that I think a great use of content management solutions. If you can take these forms, and we've provided a handful of them in the back, and you automate them, you're going to reduce the redundancy of data input. You'll improve consistency. As Linda spoke about part one, a lot of that information comes straight from the original 8038. Well, if you can enter that into an abstract, I would call it an abstract, but essentially it's a web form where all of that pertinent information that's going to be used downstream is entered into your system. It's stored, and now it can be aligned or linked relationally to documents for that bond issue. So when you come up on your annual Schedule K compliance, you have the input entered to your system. When you come up on your 5-year filing requirements for arbitrage purposes, you can embed forms that serve as questionnaires or checklists that can be forwarded to senior management and provide a dashboard as to whether or not these compliance activities have been performed, and it'll provide a report card, if you will, as to the status of compliance. Now, private use tracking, and I think this is something where it is very difficult to try and manage for the facilities and good costs and bad costs. But I think the form that Linda provided in the back is a step in the right direction, and to the extent that you can create that form electronically and that data that goes in that form link to your content management system, it will make the whole compliance so much more efficient. You won't need as many people involved, and you won't be spending as much time on it. The continued disclosure questionnaires, that's something, Kim included a questionnaire, and this is similar. It's not necessarily tax compliance oriented, but if there are disclosure issues that you need to monitor, send a quarterly or even a monthly questionnaire that's automated through your management system. A lot of time and effort. So it could be as simple as listing all of the material events that are required to be written on, and all of the relevant owners of the process, whether or not something material has happened. And on that, it'll automatically come back to you. You know if you have a problem or not. And if you don't, you just save it as evidence that you monitored it. If you have a problem, then you can call Rick or Linda or Kim, and they can help you with remedial action. If I get down to the bottom of this, and I could talk all day, we could go into a lot of layers of detail. The key is, if you are a borrower that has multiple issues outstanding, trying this stuff with paper is going to likely become a nightmare for you. If you only have a couple of bond issues, you can do that. But the key thing I've seen in response to the IRS's quest for better constituent, it costs a lot of money, and it takes a lot of resources to do this. And so I think with the use of technology, and we've seen it in a number of our clients used very well, it'll be a lot simpler. And that's something where I think both Ballard and Avant can help you. The execution aspect of your compliance program. And I could talk all day. On the last slide, what I've said there, we're not recommending or endorsing any of these, but just to illustrate, there are a number of content management solutions that are out there that are relatively inexpensive, and a lot of organizations may already have some components of these solutions already installed in their IT platforms. This is, I think, a short list of, if you want to leverage technology, you can explore these 5 and then and decide which is the best fit for you. And with that, turn it back over to Rick, and I think we can answer any questions.
Or as a 6th alternative, we would be delighted to custom design one for any client, anywhere, anytime. Let's on questions, and maybe we'll be able to provoke or incite some more, and we'll kind of do it on the same procedure. How about live in the room here in the Philadelphia office? Any questions? And I emphasize there is, in this game, there is no such thing as a dumb question. One of Kim, just to be mean. Kim, in a guaranteed investment contract, what guarantee? Nothing's guaranteed. It's just a sales term to sell the things. It just means there's a specified interest rate that's going to be paid. But specified investment contract, no one would buy that. So they came up years ago with this term, guaranteed investment contract, and that got the abbreviation GIC. Sounds kind of neat, but it's kind of ominous. But how about a question like that about what we're talking about? You know about GICs now? You know about PIC? No takers here in Philadelphia.
One.
Oh, yes.
On the Schedule K, under the arbitrage section, the 3 and 4 about the hedges and the GICs. If the proceeds were initially either a hedge or a GIC, and they terminated, you still have to disclose it. Is this the life of the bond issue, or is it just in the year of the filing?
The question was, what if an issuer or a conduit borrower entered invested proceeds in, let's call it an investment contract, or entered in year 0, 1, 2, 3, and early in the life of the issuer, and you're out 3 or 4 years now, and you're filling out Schedule K, do these questions refer only to the reporting year covered by the 4990, or do they refer to forever? Forwards wouldn't make much sense, but to go back to the date of issuance. And a lot of reasons why this is a pretty good question. One, there's no such thing as a dumb question, but this is a pretty good question because we've been feeding you mercilessly with the idea that many of the expenditure questions are cumulative from the date of issuance. When we get into the conduct questions with a gulp, instead of answering with a gulp, I'll ask Linda. What do you think, Linda?
I think that even if you did enter into it that year, you're going to have to record it. And I look at the instructions, and it's a good question because I've been sitting here while Rick was talking. It doesn't say that you have it as of that year. Whereas the private use questions ask, do you have a lease, that's in existence at that point. So I think this is part of their continuing effort just to want to know. So if you had recorded it and before you never said the hedge was terminated, but in 1 year it was terminated, then you'd be checking that box. See in the instructions that says, at this year, do you still have a GIC there?
The question is a special award for having been here 4 years ago at our introductory seminar on Schedule K. All right, where do we go next? I think it's Phoenix next.
Marie
another one. Yes, Marie.
Question, I'm not sure. I think it's the future
about the procedures that have to be in place. I think you, about the training, aspect for the people that are responsible, and that they need to be aware of the remedial procedures and for the VCAP. I mean, to what level or the people, I mean, the people who keep records, for instance, you know, like in the finance department of, like, expenditures for bond proceeds and things like that. I mean, are people also supposed to be trained on remedial procedures and VCAP?
Question was, okay, we're gonna be good people, we're gonna create a post-issuance compliance procedure, and that will ensure compliance. I love that word, ensure, spelled with an E.
It's an old Norman phrase.
The Internal Revenue Service webpage lists some elements which are in one of the things that's in the back of the book, elements that they'd like to see in a post-issuance compliance plan, and one of the things they want to hear about is procedures for training the people that are going to implement the plan. What on earth are they supposed to be trained in? And I would answer the question by saying, I think the idea is that they're supposed to be trained to be looking for, let's say, leases or possible management contract situations or some element of what they would be looking for in classifying research agreements. The second branch of that question, though, is, well, are they supposed to know about VCAP and remedial action and so forth? And I think the answer to that would be no, that you wouldn't think that the people who are implementing the compliance procedure would have to know about these different things that you do if you discover a problem. That what they should be trained at is how to spot a problem. This question kind of caught us a bit off guard. Not Marie's question to us in the seminar, but the question when it appeared on the IRS webpage this summer. Training. I mean, you Internal Revenue Service agents in the law, maybe, but the training the personnel of a hospital or a university in how to look for compliance violations, training a sort of an internal audit force. Excellent question for which we're much in your debt, Marie.
I think the general counsel's office has to do it.
But maybe we should be training them. We give seminars like this, it seems, once every 4 years, and we'll try and do it a little more frequently. Other questions, now that maybe people are loosening up and the hour when the equipment all turns off automatically is only 6 minutes away. Okay, questions in Phoenix?
We have one question for you.
Oh.
My question relates to Part 3, Private Business Use, Question 3A. The company I work for is a school, so the type of people we might have a contract with might be landscapers, handyman, professional services. So I'm wondering if you could flesh out a little bit more on that one, and give more examples of how to deal with that question.
Question, understood it, which means also as I heard it, which was a little fuzzy, not because of the questioner, but because of our magnificent electronic equipment, was what are you looking for if you're out looking for management contracts? Most of our experience with management contracts relates to food service facilities, the things you become an expert on. We marry a food service contract.
Sodexo.
I mean, we've seen them all. So we look at them because they are managing a cafeteria in whatever kind of institution. And it makes some sense there. And often the agreement will be entitled management contract. And it may be obvious that it was written by somebody who was a tax lawyer. I don't mean to pick on Marriott, it's part of their business. Same thing for Sodexo and all of them. So we look for food service, we look for medical service contracts where the contract party, the service provider is a business organization of physicians.
Parking garage management.
Parking garage management, another one we see a lot of. I'm not kidding that there is an example in the regulations that says that janitorial service is not a management contract. The janitor is not managing the facility. There's only there from midnight to 3 a.m. sort of.
Well, I think that may get to the question here, is that with the school, you know, if it's like a secondary school, it may be that you don't have food service or bookstore or some of those, but you do have the landscape, and which may be more like a janitorial. So in the harbors for management contracts, there are safe harbors for incidental contracts. And I think we probably indicated in this presentation that if you had things that really were incidental, similar to janitorial, or the person that comes in and repairs your copy machine, those types of examples, you probably wouldn't even check that you had contracts that may be private business use.
Another favorable example in the regs is billing services. You can contract out the billing services on any terms you want, provided you don't lease the billing office, but you do a management contract under any terms, any length, any compensation plan, because the theory is that the service of getting the bills out is merely incidental to the function of providing health care or higher education.
But the only way we can kind of answer this question is to say we end up looking at the list that's in the regulations and the RevProc and seeing how close the contracts you're describing come to the ones that are listed as incidental, and then we say we ignore those. Those aren't private business use.
Question from Baltimore.
We do.
Question from? Yes. Okay, we've got a question from Baltimore. I feel like we've caught a fish in
This question concerns a situation where the bond issuer is providing certificates in reliance upon certificates provided to it by other nonprofit organizations. Does the compliance obligation require the issuer to go back and revisit the subordinate certificates as part of verification that the conditions are still being satisfied?
That I have had conduit issuers who actually will send out questionnaires to confirm that their conduit borrowers were still in compliance with the various compliance procedures. However, I think that if the issuer has its own procedures and part of them include delegation, and the issuer keeps a record of that delegation and proves it delegated those responsibilities and that the other party accepted those responsibilities, that probably is enough. I don't know if you would disagree with that or not, Rick and Linda.
Well, certificates generally the service views with a little bit of skepticism if they seem to have been executed as a matter of just form. They're a lot better to have in your file than nothing. So, we have like 1 or 2 minutes left. Question from Salt Lake or Wilmington. Okay, said to be one noble person out there in Los Angeles with Matt. Person, do you have a question for us?
Person is here at the moment. No.
How about Washington, our home office, at least for Linda and me? Any questions from Washington?
Nothing here.
Okay. Now, we have a question for you. Many of you have, seminar evaluation forms that have been given to you. Our question to you, really our request is, please fill them out with glowing flattery. It makes us feel better. Thank you all very much.